Welcome back, everyone. I am Bob Mastriani, and today we're diving into the world of real estate. All right, today we're going to talk about the top 5 real estate investment strategies. When you are considering investing in a real estate investment opportunity, you really want to hone in on exactly what your plan is and what is your criteria. What is the exact type of property that you're looking to purchase? And then what is that strategy? What are you going to do with it? I hear people all the time say, I'd like to get involved in real estate, but they really haven't honed in on exactly what they want to do. So let's talk about some strategies. Strategy number 1 that I want to discuss with you today is the buy and hold strategy. The buy and hold strategy is where you buy a property and hang on to it for a extended period of time. We're talking 5, 7, 8, 10, 15, 20 years down the line, however long that is. However, it is a long-term hold. And then the opportunity is that you're going to rent out that property, right? So is this a single family property? Is it a multifamily property in a small size? We're looking at duplexes, triplexes, quads, or are we looking at larger multifamily opportunities, apartment communities, townhouses, condos, those sort of things? So these are all buy and hold strategies. A couple quick tips that I want to discuss with you. First things first is you need to make sure that you know and understand the money and the finances around the opportunity, looking at the market to make sure that rents are going to exceed expenses, right? You need to make sure that that property on a regular basis, on a monthly basis, is bringing in more in rents, and it's going to be able to justify bringing in more in rents than what the expenses are, mortgages, utility bills, and all of the other expenses. Make sure that property location is a good location that people want to stay long term. In buy and hold opportunities, one of your largest expenses is what we refer to as turnover, which means that a tenant leaves, you have to update or upgrade or refresh the property before the next tenant goes in. That becomes a really large expense. 1, because you have loss of rents, and 2, because you're going to be doing that work on a regular basis. So what is the area like? Is it an area where people are going to stay for a long time? Maybe you have families that want to move in. Maybe they want to raise their children. Maybe it's close to work. Whatever that is, make sure that it's an area where your tenants want to stay long term. If you're constantly churning over new tenants, it gets very expensive very quickly. And then talk about the management. Who's going to manage the property? One of the things that you can do to leverage some of your own time and a professional's expert experience is to bring in a property manager. Bring in somebody who's going to do that property management for you. You can learn from them if you don't have that experience, and you'll also ensure that they're collecting the rents and handling all of the work orders, what we refer to as when a question comes in or something comes in where there's a problem that needs to be fixed. Option number 2, fix and flip. Fix and flip strategy has become really popular over the last, couple decades now, when TV shows started to show you exactly what happens in the world of fix and flips opportunities. And so what's the difference here? The first difference is that this is a short-term strategy. In many fix and flip opportunities, you actually want to finish the project as quickly as you possibly can and then flip it over. So that means we're going to buy a property. We're going to reposition that property. We're going to do some work to update it and upgrade the property. We may be doing additions or whatever it takes to bring that property up to its highest and best use. And then we're going to resell that property to someone else, collect the income, and sort of move on. So a couple things that you want to do to identify. First of all, you want to make sure you're identifying a property where you have the ability to increase its value. Okay. Increase its value. When you have the ability to increase its value, you're not looking quite as much as at market conditions, whereas you're looking at the condition of the actual property. So you're going to buy a property that is not in its highest and best use, and you're going to buy it for a value price, and then make sure to increase that. Some common pitfalls that we like to make sure that we steer clear of. First things first is that many of these projects go longer than expected, which becomes expensive because the longer you hold, the more expensive the property is. And we also find things, right? So you want to do as much due diligence on the front end to ensure that you don't have as many oops factors and you find a bunch of things that have to be added on that weren't in the original work order on the property. Some key metrics to consider, again, when we're looking from an investor standpoint at buying a fix and flip property, we want to look at a term that's called ARV, which is after repair value. What is that property going to be worth after we've done the repairs, right? We're going to take a percentage of that so that that's where our profit is. And then we're going to subtract out all the costs to get it to that use. And then that's around where we're going to buy the property for. So make sure whenever you're making offers on properties that you're going to fix and flip, that you're including your cost of renovations and also your cost of profit. Include in all your renovations, any expenses that you think you're going to have. These are short-term strategies, though. In many cases, we're looking at fix and flip properties to be completed in 3 to 6 months. That's a really good time frame. If you can get them done in less than 3 months and sold, that's really, really good. And anything longer than 6 months is really hanging on and becoming very, very expensive for you. So make sure that you're looking at those fix and flip properties from a very different eye and very different lens and perspective than you are from those long-term buy and hold properties. Strategy number 3 that I want to refer to is a bit of a hybrid of the two that we just talked about. It's called the BRRR method, BRRRR. And that's where you go and buy a property. You're going to renovate the property. You're going to rent it out. You're going to refinance it and then repeat, do it all over again. So this is a bit of a hybrid of the two that we just spoke about. It's got a little bit of a fix and flip in it. Whereas you're going to buy it in the same way that you buy a fix and flip opportunity. You're going to buy it with the intent to renovate the property, bring it up to its highest and best use. Then you're going to rent it out and refinance it. So when you rent it out and refinance it, you're going to change all of your funding so that it now has a long-term play. In many cases, when you rent out the property and refinance it, you'll actually get a lot of that original startup capital add. And now you're going to look at it from a buy and hold perspective. So what does it look like as far as rents coming in, property management, being able to collect monthly income on that property and sort of go for the long haul. So BRRRR has become very popular over the past several years, and it's a great strategy. We have some properties that we've BRRR'd over the years, and we hang on to them for a really long time, and they become really good regular cash flow investment opportunities. But it's a great hybrid of fix and flip and buy and hold strategy. Strategy number 4 that we're going to talk about is commercial real estate investing. So commercial real estate is different from residential real estate in that we're now talking about office space, retail space, industrial space. Are you looking at potentially strip malls and shopping centers, or even potentially what's called mixed use? Mixed use is where you have some commercial and some residential, and we have a multiple use. Mixed uses means there's multiple uses of that property. Some of the things to take into consideration with commercial. Oftentimes when you're renting out commercial facilities, when you're renting out commercial properties, you're going to have longer term leases. So it's very common in residential real estate to have 12-month leases, and they sort of turn over every 12 months or shorter. When you're looking at residential properties, you're often looking at 3, 4, 5, 7-year leases. So those leases are extended a lot further out, oftentimes with higher income. One of the things to keep an eye on is that you really want to know your tenant. Whether you have a 5, 7, 8, 10, 12-year lease, it doesn't even matter. If that tenant is a business that is not sustainable and they go out of business, you don't have a tenant. In commercial real estate, we find that the turnover process, when one tenant leaves and the next tenant comes in, is usually a lot longer. It also seems to take a little bit longer to actually sell commercial properties. So we want to keep those things in mind. Property management is a little bit different in that oftentimes the care and upkeep of the property is actually passed on to the tenant. That could be decided in how you lease out the property. So property management is a little bit different. We're talking a little bit more about asset management from that perspective. So commercial investment is a great investment. You also are looking at different financing. So in a commercial investment, they're often looking at financing of the property as a business. So how does it cash flow? Is it going to be able to pay the bills versus you specifically as an individual and your personal income? So that's commercial real estate investing. And then if all of that seems a little bit too much for you and you just want to put your money to work in a real estate investment opportunity, we have option 5, which is what I'll refer to as fund investing. There are many different options here, but the options essentially mean that groups of investors are going to put their monies together. They're going to select an operator, and that operator is going to find the opportunity and make sure that the opportunity work. So this can come in several different form fitting. One is what we refer to as REITs, which is a real estate investment trust. And a real estate investment trust has the ability to sort of pool a bunch of money together and invest that in multiple different real estate investment opportunities. We also have what's called syndication. And syndication means that a certain group of people become what's called general partners in the opportunity. And those general partners are going to find the opportunity. They're going to manage the opportunity. They're going to take care of seeing that the asset is managed and that the property is managed and that the tenants are taken care of and all of that sort of stuff. And then the other group in that investment is what's referred to as the limited partners. And in most cases, the limited partners are people who are just investing their money. So there's a few different options here, but if the idea of finding the property yourself and managing the property and managing all the day-to-day of it seems like it's a lot, but you still have money that you want to invest in real estate, there are several different options in fund investing where you can be part of pooling a lot of different funds together with other investors to find an opportunity that works for you. And it's going to take some of that responsibility to handle the actual day-to-day of the property on your own. So there they are, top 5 real estate investment opportunities. Let me know what your thoughts are and which of those opportunities seems the best for you. My name is Bob Mastriani. I host a community in school called the Healthy Investor Community and also a podcast called the Healthy Investor Podcast, where I help entrepreneurs and investors understand how to start investing in real estate. And I want to do the same for you. Go out there and make it a great day.